Hey everybody, Preston Brent here with our weekly roundup with the Trader User Group. This is the weekly roundup through 10/14/2016. What I've got on the screen here is the E-mini S&P 500 futures. I've got a daily chart up here. And what I want to just remind everybody is that we're going into corporate earnings for Q3. And as I've been telling our members for the past couple of months now, this Q3 is going to be probably more important than Q1 or 2 earnings for this year, or even Q4 last year. We've had 5 quarters in a row of declining earnings per share, 5 in a row. And FactSet is projecting that it will be 6 in a row for this third quarter earnings. Well, we've had stock action move higher and higher on just on year-over-year earnings decline, and that's not going to keep going this way. I think right now what we're going to see is as earnings, if companies miss their earnings, they're going to get punished more so than they have in previous quarters. I just don't see the markets really treating companies like they have in the past. For instance, we had Alcoa kick off earnings Tuesday of this week, and they had a miss, and boy, did they I think they had one of the biggest pullbacks in 4 or 5 years, over 10%, 12%, which is a lot for Alcoa. Illumina came out, they didn't do very well either, and they had a huge pullback. So we're seeing in this quarter here, these higher valuations in the S&P are just not going to hold up with companies that keep reporting underwhelming performance in their corporate earnings. And as usual, most analysts stack the end of the year where they see companies performing. They always downgrade performance during the year, and they back in the year with where they think the earnings are going to happen. So now we're coming into Q3 and then Q4. So that is one of the points that I want to make here. The other one that I want to make is that volatility's returned back to the market. We've had 2 weeks now with the markets pulling back, and the way we went into close this Friday was more bearish than it was bullish. I mean, even though we had bank stocks come out, JP Morgan, Citi, Wells Fargo beat earnings, they moved up, they got markets up, but then around midday going into the afternoon hours, markets started coming back down and we closed near the lows, which is not a good sign. A couple of key levels that we're watching that I'm going to show you guys. Now on this chart here, you can see that the blue over here, this right here is volume at various price levels. So it basically shows how much volume, how many shares were traded at each of these levels. And it's really good because it also helps you just get an idea of at a higher level, where is all the support, where is all the resistance, overhead supply, underneath support, that kind of thing. So let's take a look at this here. Now, the one thing that I wanted to show you is if we look at a trend line, and I'm just going to put one on here, and I'm going to connect the dots. Right here. This is a key trend line. This trend line right here started on the February lows. If you guys recall, back in December here, the Feds surprisingly came out and said, hey, we're going to hike the rates. And they had the first rate hike since, I think, 2009 or 2007, I think. They raised the rates, but then they said they're going to raise the rates probably 4 times in 2016. Of course, that never happened, but the markets did sell off. And finally, they got their wind here in around February the 11th. We got a great bullish signal, and I was getting everybody long right in this area here, actually down in this area here. However, if you look at this trend line and you take a look at where we're sitting here, you can see we spent a couple of days there. We came down right on that trend line right there. We went below it, but since this is a daily time frame, the bulls pushed us back up above that trend line, and we are sitting on it right now. If I were to blow this up, you can see that trend line and where we're sitting. Okay. Now, we've got a couple of key levels that I'm going to be watching for this coming week. One of them is sitting here at this pivot low right there. That was in early September. we had two back-to-back hard down days in the market on the September the 9th, and then back on September the 12th, a Friday and a Monday. It was two hard days. We came down, we moved up, and then we came right back down again. The bears pushed it back down. The bulls tried to get up, but they really couldn't do it. If you look at it from this level here, the bulls tried to come up into this area right here. And they just could not make it. So now we've got to make a determination here. These all-time highs here, 21.90.75. Will the bulls be able to get back up in this area, or will they come back down again? Okay, we are sitting on this key level. So should this key level break here on a day bar? Now, remember, if the bar opens here, goes up, then it comes down and it closes here like that. So that's where we close. I'm looking for follow through on the next bar. If we open here, go down, and we come up, and then we close right here, there is no follow through in that bar. Okay, we need follow through to see any more serious selling going on. You can see right here, even though we went below the trend line, the bulls pushed us back up, and you can see the tight grouping of the open and the close. It's almost like where the bears are in control, but the bulls are just buying these dips right here. Okay, and then it's more of a day trader's market, because there's nobody once the markets run up that really want to add more longs. People just selling and pushing it back down again, but then the bulls are pushing it back up. This battle is going to end pretty soon. Okay, I believe Q3 earnings is going to force a resolution in this. Now, what I want to remind everybody is that if we, and let me just draw another trend line on here, and I'll just draw it with my pen. If I draw it like that, right, and come down, or let me just try it just a little bit better. I think I could probably draw it better than that. If we have this line here that comes down, it would help if I activate my pen, wouldn't it? But if we draw this trend line coming through like that, you can see right there, again, no follow through, we didn't go through, but we're winding up. Okay, we did not come down here. Here's the 200 EMA. One of these is going to break. Now, this is a symmetrical triangle. All right, I could draw this triangle like this, and call it a valid triangle as well. It is a symmetrical triangle. When you approach a symmetrical triangle from the bottom up, the odds favor a break to the upside, and the distance of the objective move is roughly the distance right here. Okay, that would be the objective move, but it's right now it's slight edge to the upside, but you know, just watching the way we're closing and the way the bears are really pushing this price down, if corporate earnings don't come in at or above expectations, I think we're going for a ride to the downside. And obviously the first key pivot, which you can see on your screen because I drew it, is right here. It just happens to be at 2125 cents, which is the pivot low there. If we break that, folks, right below it is the 200 EMA at about 2091. And that'll kind of be the stop gap measure should we come back down in this area. If we break it to the downside, the first thing I'm going to look for is within a day or two a retest of this area. Okay. And that's common when you break a key pivot level. And then on that retest, if we do go back up and hold, that's a very bullish sign. But if this retest fails, which is what I believe it will happen, and we take out that pivot low that forms on the turn back up again, folks, our next stop off in this thing is way down here on the Brexit lows at 1981.50 on the E-mini S&P 500 futures. It is a long, long way down. There is not a lot of things getting in the way down here. A lot of empty space. Look out below. Now, if I say what is the distance of that, it's not a very big pullback. All right, if we look at this and we just say what would be the move here, and we come down like that, and we just come down from that level there, it's roughly about 10%. Okay, now I want to remind you guys, October of last year was a great month. but December was not. If we come back when the Feds announced their rate hike and we look at the pullback that we had here from this one, we came from right here all the way down to that pivot low right there, roughly in the E-mini futures. Now let me just line it up here from the highs. Right there, about 14.26%. Okay, so that was the move. It started at this pivot high right here. Actually, it's a little bit higher if you wanted to count the highs over here at 2110. Okay, so call it roughly 15% in the S&P 500 futures. All right, now over here, and you can also see and I'll box it in here. Here is the month of October right here. October was a good month, right? We opened up the month of October. Well, I just deleted it. Let's try it again. We opened up the month of October here down at the bottom down here, and we closed at the top. The month of November was relatively flat. We had a little bit of a dip, but came right back up, right about where we started. But then, when the Feds hiked the rates right around in this area here, we came down up into the rates and boom, and then away we went like that. It gave it all up, and that is what kicked off the month of January, and then we just started to the downside. Had a little bit of a bull trap there, came back down, did a retest, and then I got our members long right in that area right there. Okay. Once we did that test. Now, is that same pattern going to repeat here? Well, remember, this is October. We had a great October. Historically speaking, the first 3 weeks of October are the worst, and then the last week of October is the best. So we're into October right now, and we are off of where we approached October. We moved into October at around 2158.75. And as you can see right here, we're now at 2127 roughly. So we're down about 20 points or so, or 30 points, roughly. So this is kind of where we're sitting. And these are the key levels. And should we break the 200 EMA, we're going to come down to about a 9 or a 10%. At this point in time, I don't think it's going to be a very nasty pullback. Although if we do break and we start coming down, you're going to see all the talking heads on TV, and you're going to see all the newspaper business journals saying, this is the big pullback. This is where we're going. Everybody's fearful. And, sometime in this area here, let's not forget, in less than 3 weeks or so, we've got the presidential elections in the U.S. So it's going to tend to be volatile going through October, I believe, into November, November 8th. For those of you that are not U.S. based, that's when our presidential elections are. So we're going to have a very volatile time. But these are the key levels, guys. Now, I'm going to take them back off the screen, and then I will put my normal markings on the screen so you can see my price levels and key ones that I'm following here. This is where we're looking. You can also see the only thing that is a little bit of a saving grace, if we do break this key level right here coming down, we have the 2016 open price at 2037.75. Okay. But if we break this level, this may provide a little bit of a stop, but then I think we're going back down here like that. By the time we get down here, vol will be up in the mid to upper 20s. And it'll get there fairly quickly. Okay, so now am I saying we're going to break? I don't know, but if we do break, we've got a little bit of a zone here, kind of a catch basin also right here with the 200 EMA. So we do have some good support. If we start to get, and this would be one of those rare instances where corporate earnings really do matter. In the prior quarterly reports, I mean, the Feds or ECB over in Europe, or the BOE, or the Bank of Japan, or China was willing to step in. I think each time the central bank comes in with more money, the markets get a little bit more disappointed that they're just not able to stop this. The central banks have been flooding the global markets with money since 2009, and we're still at almost no inflation. although parts of the economy we can see signs of inflation. But really, for the money that they put in, no inflation, interest rates zero or negative, 12 trillion plus in global debt, negative. So I think there's more reasons psychologically for the price action to go down than go up. But if we've got good earnings, I think you're going to see us come up, challenge the all-time highs here at 21.91.50, and we'll probably move up from there. So these are the key levels, guy. There's no need to really guess or just kind of say what do we think's going to happen. But this is kind of how I'm looking at things right now. And of course, if we look at volatility, it finished at 1612. Look at this, guys. We were up strong today, but volatility, it really kind of held up throughout the entire day. I mean, the VIX was only down, what, 40 cents off the highs from the day and the prior day. So we're in zone 2 for our members. You know what we use that for. So we're in zone 2 for volatility for our option strategies. And you can see here that we just got to be careful, because once we get up in this level here, any upside movement tends to be very sharp and very painful. Now, we traded volatility back over here, and we did very well in the trade. We may look to get back into it again, depending on how we open Monday going into Tuesday, okay? And we're going to be in full boogie tilt with earnings next week here in the U.S. Now, the other thing I wanted to show you in bonds is giving it up. Bonds down hard today. Look at this. Oh, my goodness. And there is absolutely we did not get any kind of cross in the MACD. We got a low and a lower low here. It's almost, I would call it what we would say is a zero bullish divergence, which suggests that any move up here is going to quickly be sold off and push it right back down again. And we're in that situation where any down move in bonds, we can also see a down move in equity. So we'll be in one of those situations where equities are going down and bonds are going down and the dollar is moving higher. Now, we've been long TBT for at least several months on this trade. And I think that's still got some ways to go to the upside. So TBT, if you believe in interest rates moving a little bit higher, and just today, they can't keep their mouths shut, but one of the Fed governors, I think from Boston, Rosengren, he's not, he's a Fed governor in Boston, but he came out and said he could see more than a couple of rate hikes this year, or in 2017, not just one and done kind of thing. So that's going to have a tendency to put downward pressure on the bonds and upward pressure on the US dollar. And speaking of the dollar, it was up strong today. Look at this. We had this key breakout and it held on a daily chart. Okay. If we step it out a little bit, you can see where we're sitting. And I've said that once we break out here, the odds favor a move up to the 100 area on this index, on the dollar index. So that is not going to look good for the other currencies out there. If we look at the euro is down hard today. We finally broke through the 110 area. Now we're at 110.09, I think. So we're right down in this area. We're near the 2016 open price for the euro. All right. And if we look at the yen actually came down just a little bit on really good news out of China and their inflationary data. But you got to be careful, because if we have a global implosion, the yen is going to get stronger. The Nikkei will get weaker. And then of course we got the British pound. Poor old pound. We're getting pounded here. I think it's going to go even lower. Even though we got this 345 Elliott wave pattern, I think any upward movement here is going to be short and sweet. A lot of shorts in this trade now, so I think it's a crowded trade to the downside. So we have a tendency to have really fast, hard thrust to the upside, and then you get those fast, hard thrusts. You're going to want to short it, sell into it, and there's a bear flag right there, which would indicate more downside action is coming. I've seen some analysts say we can come down to 110 in the British pound. If we get down in this area, like I said, once we get down in this area, I'm going to be a longer term buyer. Near term, it's a day trading tool, and that's about all it is. Gold, well, gold is also not having a good time. I said that gold's probably going to come down to the 1200 area. And then find some support here before rallying higher, probably in 2017. I see near-term weakness for gold, okay? Um, if we come down and we look at oil, well, our members know we've got some good trades on. We're using ratio, we're doing short ratio strangles in the oil futures market. We came up and hit my target here very nicely, both time and price. We do not have any bearish divergence, which would suggest any down move is going to be met by buyers pushing it up. So selling puts underneath 40, the 40 strike makes a lot of sense to me. And selling calls above the 60 strike makes a lot of sense for me using the DEES contract. So we're doing that in a ratio. Not one for one on each side, and I think it's going to continue to hold through the DEES contract expiry period. So we're playing that really nice. Now nat gas has moved up very strong. We've actually, and I didn't mark it here, but we made a new high in nat gas on Thursday. We've got, I believe the Farmer's Almanac is forecasting a colder than normal winter, which will get nat gas up even higher than this. Okay, if we look at a weekly chart on nat gas, you can see here that we've had a key breakout. The next level is going to be 354. Then we're coming up to 418 and 454. I don't think we're going to get much higher than this level. And if I were to mark it on the chart, you would see it pretty much like that. I just don't see us getting up much higher than this. But if you go out in time, you'll be able to get some nice shorts on short calls in the market. But near term, I think we can still head higher for natural gas. You know, that's kind of where I'm seeing that. In the ag market, well, we're going to be entering some new trades in the ag market. I've been talking about these for a while. We've been kind of range bound for the ag, just because there is so much inventory out there. We're coming into harvest season. The seasonality for October or going into October tends to be to the downside, but then this is when it shows strength. You can see we had a breakout in wheat, and you know, I was talking to our members about selling puts underneath wheat. I think wheat's going to come back up into this area up here around 460, 455, 460. That's like the same thing as saying $4.60 a bushel. So that's where I think that's going to go. So we got some opportunities there. Same thing with corn. They all kind of go together. You can see corn also had a breakout. I think corn is going to go back up into the 360 area, 380 area, somewhere up in this area here. Okay, so that's in the ag market. Meats have just been horrendously crappy. We're looking for a long in meats a little bit later, and then obviously the other one that we're into is orange juice. We had a great break in OJ. Now you guys know I've been talking about it. I'm short orange juice futures, and I said if we can break out of this little area right here, right in that little box there, it's going to go for a ride. I think we're coming down to this area here. Now we broke out. We had follow through on the very second bar. We took out the 50 EMA. So, you know, with that follow through, I have more confidence. We may run back up and test it, but I have more confidence, as much confidence as a trader could have, that the pattern seems to indicate we're going to come down. And the 200 EMA is working its way up, and it's going to start to flatten as price runs down. So right in that area there is where I'm going to be targeting, tightening my stops. Okay. Just to show you just how far out of whack OJ got, I'm going to put it on a weekly chart here. This is why I love shorting commodities. Look at these all-time highs. We had one all-time high in the OJ area right here. We got higher here, and now we're up in this area here. Folks, orange juice is not going to stay up these levels very long. Okay, now this is a weekly chart. So here we were there for about a month. Here we were there for about 3 weeks. All right, and here it's been 1 week. So, and if you look at the downside action, it's very choppy, but the backside is, if you're holding futures contracts, it's a wild ride. Now, I'm just talking about this is where we are right now, coming down to this area here. but we could come back down into this area here, which would be, you know, a nice sizable gain on any short future. So that's kind of where I'm looking at the OJ. All right, everybody, that's pretty much it. If you're not a member of our group, I highly encourage you to come in and check us out. We're doing a number of things across the commodity complex and in the equity markets. So members, I'll see you Sunday night. We've got some active trades that we're following, and we'll go through them Sunday night. Otherwise, everybody have a great weekend, and I will catch you on our next weekly roundup. Take care, everybody. Ciao.